Everybody's doing well. Today I'm going to be talking to you about the mortgage process, and I will go over what happens when somebody applies for a mortgage, whether it be a purchase or a refinance, and walk you through the steps the operations team goes through. My name is Abdiel Garcia. I'm the Senior Vice President for Montecito Bank Trust and the Director of Consumer and Small Business Operations. A couple of disclaimers that we have here for you before we start. The presentation today is presented only for educational purposes. The information contained herein is for general nature and is not intended to address the individual circumstances or any person or entity. While we make every effort to offer accurate information, errors can occur, and laws and regulations referred herein may change over time, are subject to interpretation, and should be interpreted only in regards to the specific circumstances you may have. And last but not least, the information presented is not any legal, tax, accounting, or financial planning advice. It's strongly recommended that before you engage in any dealings, you go and consult with a professional to help you pursuing any course of action. So today I will be covering some general terms of mortgage. These are terms that are common practice, and some borrowers or applicants may not know necessarily what they mean. And then I'm going to jump into the application process, processing, underwriting, and closing. So the first term that we have is a pre-qualification versus a pre-approval. A pre-qualification is a preliminary review and determination of what an applicant can afford. It's totally cursory. The underwriters do not really review any information for the borrower or applicant, and it doesn't take into account any credit profile. So when you guys are trying to make a purchase, a pre-qualification, while it gives you an idea of what you can afford, it doesn't really provide any safety to the buyer or the selling agent that you are going to be qualified for the loan. A pre-approval, though, that gives you that assurance that you need and the seller's assurance that you are going to qualify for the mortgage. You have been pre-approved for up to a certain loan amount, and the pre-approval is conditioned upon an appraisal acceptable to the bank, title policy that's clean, that the bank is going to have clean title in the property, and some minor conditions that may be pending on once you identify the property. But your income, your asset documentation has already gone through the rigorous underwriting process that we have. And again, it is an assurance to the selling agent and the seller that you have been pre-approved up to a certain loan amount. And that really, unless there's something major that happens with your employment or asset information, that you will get the loan to close in time. A pre-approval usually closes, once you identify the property, it's a lot faster to close the loan for the purchase. And a pre-qualification, you have to start basically from the beginning so that the underwriter can look at the entire package at a later time. So occupancy, this is a common misconception that I find with our clients. When you're buying a primary residence, the borrower or applicant must occupy the subject property. Some lenders allow a co-borrower that will not live on the property to be on the loan as well. However, if that is the case, let's say you're purchasing a house with a family member, you must disclose that information to your lender up front so they can tell you if that is a structure that they are willing to entertain and give you a pre-approval or do the loan. A second home or vacation home, that is a property that the primary borrower will not use on a regular basis, but you will occupy, from time to time. Examples are vacation homes, a beach house, a cabin up in the lake, somewhere where you are going to go, but it won't be your primary residence. And an investment property, is something that will be used as an income producing residence for you, and you do not intend to occupy on a regular basis or full time at all. So investment properties and second homes may have some changes in pricing that could be a little bit more expensive than the primary residence, but that's why it's important to identify which type of property it is for you so that you don't have any changes as you start your application process. Debt to income ratio. The debt to income ratio is the most important ratio lenders look at. That basically tells a lender what your gross monthly income is before taxes and what amount of that gross monthly income goes to pay for rent, mortgage, credit cards, or any other debt that you have. So there are two kinds of debt to income ratios. There's the front end debt to income ratio, and that is calculated based on what your future or your new monthly principal, interest, property taxes, and insurance payment, or as we know it as the PITI payment, will be on your home divided by the gross monthly income. Some lenders have a restriction on how high your front end ratio can be. Some say that your PITI payment cannot exceed more than 30% of your gross monthly income before taxes. Others don't have that restriction. So again, it's a question that we should ask our lenders when we identify them if they have a front end ratio requirement. And that can limit the type of property that you're looking at to purchase if they do have a requirement. The back end ratio. This ratio includes your PITI payments, or your principal, interest, taxes, and insurance, plus any other debt obligation that you have. And that would be the minimum monthly payment that you have to make based on the credit report information. Once we pull the credit report, we're going to see what those minimum payments are. The lender will then, add up all those payments, the monthly debt obligation, and divide it over your gross monthly income before taxes and determine what the ratio is. One key thing to notice is that personal and household expenses, such as utilities, food, clothing, gardening, they're not part of the DTI calculation. So here's a brief example. If your principal, interest, taxes, and insurance plus other, let's say credit card payments are $43 a month, and your gross monthly income is $100 a month, then your DTI payment will be 43%. So you divide the $43 over the 100, and that's your 43%. So in general, most lenders consider the back-end DTI ratio of 43% an acceptable qualifying ratio. If your ratio is higher than that, that may not, you may receive a decline on the loan. However, there are some exceptions that a borrower or applicant could go up to 50% DTI if the mortgage is going to be backed by a government-sponsored agency, such as Fannie Mae and Freddie Mac. But again, if you know from the get-go that your DTI will be higher than 43%, talk to your lender and explain the situations, and they're going to be able to guide you and tell you what loan program you should be considering for your application. So selecting a lender. What are the things that are most important when selecting a lender? There's a lot of lenders out there, and each one of them is going to tell you that they're the best fit for you. However, it is recommended that you shop around. Always talk to several lenders before you decide to go with one. A mortgage product may seem reasonable until you compare that product, which is a similar product, to another lender. That could include fees. That could include points that you pay on the loan. Points are a percentage of the overall loan that a lender may be charging you. That could be thousands of dollars. Others may not have that cost to you. It could be a processing fee, an underwriting fee that is hidden, that will be disclosed to you, but if you don't know to look for it, you may be surprised down the line when you get closing disclosure that gives you all the final fees on your loan. So it's always important to ask questions. Don't sign anything if you're not sure, and shop around to really find the best option out there for you. The application process. So once a lender is selected, a mortgage loan officer will assist you in completing the application. So in January of 2021, we had a change for our uniform residential loan mortgage application, went from 4.5 pages to about 9.5 pages. So yes, it is a lot of information that the MLO will be asking of you to complete your application. Don't get frustrated. It can be a little daunting, but the more information we have up front as a lender, the faster we can help you close your loan. As you fill in the information, please take extra care and make sure that all the information is accurate and complete. Any mistakes can slow down the processing time and create problems when the underwriter reviews the package. You know, that could be, you know, incorrect name, incorrect social security number, you know, and when we run all of our credit reports and we look at and compare the data that we have, all the warnings in the credit report, that could create a lot more letters of explanation that will need to be completed to address the issues or the warnings that we have in those reports. So after you complete the application, within 3 days after submitting it, you should receive a loan estimate. The loan estimate will cover all the details of your loan, including your expected monthly payments, the estimated closing cost, and the loan terms. Again, this is a document that you need to review to ensure that everything that you were discussing with your mortgage loan officer is included here. And if anything doesn't seem reasonable, or if you have questions on any fees, please ask your lender and they will be able to explain them to you. And again, at this point in time, you can still go to another lender and say, hey, what are your fees, and determine the best option for you. But it's important, again, not to sign anything that will tie you in with that lender until you're sure that, you know, they are the correct lender for you. So once the application is submitted, the loan officer will request, in general, the following financial information. So it's going to be 1 month of consecutive pay stubs. So today is 6/15, June 15th. So what that means is that if you are a W-2 or a pay stub earner, you're going to be providing your pay stub for 5/15 through 6/15. That will cover a month of pay stubs. You're also going to be providing the last 2 years of W-2s, tax returns, or business tax returns if applicable, a profit and loss statements if you're self-employed, and any pension or social security award letters if you receive it. There could be a lot more information or documentation that an underwriter may request if you receive other sources of revenue. So if you know you get capital gains up front, disclose that to your loan officer, and they will be able to tell you what else to provide to use that income for qualifying purposes. Regarding assets, you're going to need to provide, at a minimum, the most recent 2 months bank statements with all pages attached, and that is for any savings, checkings, or brokerage accounts, investments accounts that you may have. And again, the purpose of assets is to see how much in reserves you have. Most lenders have principal, interest, taxes, and insurance payment reserve requirements to close the loan, and also to know where the closing costs are going to be coming from, and know that the borrower or applicant has the ability to close the loan. Additional documents that may come up, if it's a purchase, obviously a fully executed purchase contract with evidence of where the down payment is coming from. If the house you're refinancing or purchasing is a planned unit development or has an association, such as a condo, we're going to need the homeowners association documentation and any contact information for that homeowners association so that we can request some documentation from them and do a certification that means that there's no pending lawsuit or litigation against that HOA, and to get the insurance coverage that they have for the common areas. Another thing that we commonly see are derogatory information in credit reports. That could be, you went on vacation and you had an issue where your bank thought your information was stolen, and they stopped all payments out of the checking account, and you happen to have an auto debit to pay your credit card bill out of the checking account. Well, if that happens, if the bank terminates your auto payments, then you may have a late reported on your credit card payment because the payment wouldn't have gone made. So a letter of explanation would help us clarify those issues that, hey, this is a one-time occurrence, explain what happened, and then the underwriter will take that into consideration when they underwrite your loan. But there could be multiple reasons for derogatory credit. And again, if you disclose those information up front, or when your loan officer goes over the credit report with you, then you can identify those issues and provide a letter of explanation ahead of time before the file goes to underwrite. So once the MLO prepares the package and submits it to processing, a processor will gather the documentation for the borrower and property, review the package that the MLO provided, and start working the file to make sure that all of the nuances get done. There's a lot of verifications that need to happen at this point in time. There's a lot of AKAs. I mean, as we know, some of us have middle names, and we go by the initial on some paperwork. Others may include the full middle name, or also known as, different names that you may have used in the past, different addresses where you may have lived. And the processors will make sure that, all of those additional names, addresses, or any discrepancies that we find in the file are properly addressed, that we have all the AKAs letters for you to sign with loan docs, or all of the different letters of explanation for addresses. And really that helps us identify that we're dealing with the correct individual. If, we have some softwares that help us identify red flags, and we are able to detect quite a bit of fraud through this process. But again, if you know of addresses or AKAs that you may have used in the past, the faster you disclose that to the lender, the easier it's going to be to go through this process. So as the processor completes their initial reviews and orders the appraisal, they send the file to underwriting so that the underwriter can review the financial package and the work that the processor did. So here the underwriters really closely evaluate all the documentation prepared, and they go through the 5 C's of credit. I'm going to talk about them a little bit later. But in this phase, the underwriting phase, again, the underwriters are using a magnifying glass and identify any red flags possible that could indicate potential fraud. And if there are such red flags, again, we're going to require additional information to confirm that it is the applicant that we're talking to and the intended owner of the property. Once an underwriting decision is made, the underwriter either approves or declines the loan, and sometimes they approve the loan subject to conditions. Such times, it could be because the appraisal is not in yet, so we need to verify, and review the appraisal before final approval is given. It could be because there's alimony or child support payments that are being received or made, and we need additional information on that. It could be for multitude reasons, but at least we know that your loan is approved as long as we receive the documentation that the underwriter has conditioned the loan with. So talking about the 5 C's of credit, this is important for us to identify, and for you guys to be aware, again, this is what the underwriters look for. Number 1 is credit history. So this is looking at the credit report, identifying what your FICO score is, and looking at any derogatory information or warnings that we may have. And again, we're going to address any warnings or discrepancies and look at the credit history to see if the borrower and applicant are creditworthy. The second C is capacity. So the capacity is really, can the borrower support the payments? And the intent of lenders is not to put the consumer in a bad spot where they're going to lose the property down the line. So we really want to make sure that the income is going to be recurring income, and that they are able to make the payments on the home. Now, I understand a lot of things can happen. We may lose our jobs. I mean, last year the pandemic hit and a lot of us were furloughed, and we weren't getting payments, but those are extreme circumstances, and there are options out there. Once, you own a home and you have a mortgage, and if you go through a downtime, in your work or your income, and there's a disruption in your income, there are a lot of solutions out there for you to, or resources out there for you to consider. However, for underwriting purposes, we look at the continuation of the income. And if you are a W-2 employee, then, what is the likelihood that you're going to continue there? And when we request our verification of employment, your employer will be noting there, if yes, there's likelihood that this individual will continue, and that will suffice for us. If you are a self-employed individual, then we're going to look at the financial capacity of the business, make sure that it is generating revenue. And again, the assumption will be that if you have the last 5 years or so you've made money, then that you will continue doing the same in future to continue making payments. The other C of credit is collateral. So once the appraisal is received, we're going to review the appraisals to ensure that there's really no deferred maintenance or environmental issues with the property. I had a case once where the property was downstream from a chemical plant, and unfortunately the chemical plant was leaking chemicals, and it went underground, and the appraiser identified some stains on the ground that require additional mitigating factors to make the loan. So all of the appraiser will look at that, although they're not an environmental expert, but they can see if there's something unusual with the property, and then let us know what is recommended, what the next step would be. But that is the collateral. Again, the underwriter will review the appraisal in detail to ensure that the property is acceptable to the bank. The fourth C is capital. So again, I mentioned earlier that some lenders have a PITI reserve requirement, and they require some reserve level. So if your monthly principal interest, taxes and insurance payments is $1,000 a month, then they may require you to have 10 months of PITI reserves, which means you have to have at least $10,000 in reserves that will not be used for the down payment or the closing costs on the loan. And that becomes handy should you have a disruption in your income, is like a little piggy bank that you use for the mortgage. The last C is conditions. And again, as the underwriters review the file, they look at what conditions are required of the loan, and they list them that you will be approved subject to you meeting those conditions. But other than that, I mean, those are the 5 C's of credit that the underwriters review, and hopefully by the end of their review, they have an approval for you to go and refinance and lower your payments, or get cash out, or buy the house that you've been dreaming of. So once the underwriter and processor completes their process, they forward the loan to the closing department. So the closing department is the last step in the mortgage process. They will issue a closing disclosure in which it will have all of the final terms and costs on the loan. These are final, they're not estimates anymore. The regulations give borrowers 3 days to review the final cost and terms on the loan. If after 3 days you still want to proceed with the loan, then the closers will prepare the loan documents and send them to your escrow company. The escrow company will then set up an appointment with the applicant and borrower and to sign the documents. Again, the documents are, it's going to be a large stack of paper, so be patient, take comfy shoes and clothes, because you could be there for, you know, an hour or so signing those documents and reviewing the documents. At this stage, consider yourself, you know, a spaceship at the launching pad, and the countdown has begun. So we're almost there. If you find issues, let's say, you know, your name is misspelled on the property, or you have the wrong address or zip code or something like that, those are easy fixes. The closer and doc preparer will be on standby. So if the escrow officer sees, oh, there's a mistake on, again, something minor, they can make the changes and resend those documents back to the escrow officer. If for whatever reason, you know, you decide at that point in time to increase your loan amount because you want to pay your taxes that are now due, you know, that may delay the closing cost, and you will reset the 3-day waiting period, and the loan may need to go back to underwriting to make sure that you have the capacity to, you know, make the larger payments. So that could delay loans, you know, the closing on a loan. But that rarely happens, and we do see, again, if it's a minor change, that is a pretty easy change for us to make. So once the loan documents are executed, the escrow officer sends them back to the bank, at which time the funder and closer review the documents to make sure every page was signed where it needed to be, that all of those letters of explanations were properly executed, and explanations were given to all of the explanations we needed. And once we confirm that everything is fine, a funding date and time is set. So we talk to your escrow officer, we tell them when they're going to be receiving the money. We make one last phone call to you, the borrower, at that point in time, and confirm that you do not want to rescind the loan and you want to proceed. And once you get that confirmation, the loan can fund. So the timing, all in all, you know, if it's a purchase and we do a pre-approval, lenders tend to be between 30 and 45 days, depending on complexity and depending on appraisal. You know, if it's a large property, an appraiser may take a little bit longer than if it's a, you know, a smaller tract home. And refinances, again, depending on complexity, they can vary between 30 and 60 days. Make sure that you have enough time in your lock period when you lock the rate to cover the close of escrow, to make sure that you don't pay any extension fees down the line. And again, one last reminder, the faster we obtain the required documentation, the faster we can close the loan. So that's it for us here. You know, if you guys are looking for a refinance or a purchase, by all means, please contact Montecito Bank Trust. There's a phone number there, 805-963-7511, or go to montecito.bank and you can find all of our wonderful loan officers that are willing to help you and get in contact with you. Thank you.